Well, welcome. Appreciate you guys coming. Appreciate you guys signing up. So this is the monthly market update. So like I said, big picture of the US economy and as it ties into the real estate market. So I'll do a single family update and then a multifamily update that's really focused on commercial multifamily. So, 5 units and above, that sort of thing. That's really what I focus on. That's what I'm hunting out in really the East Coast. Charlotte and the Carolinas is my target markets right now. Also like Phoenix as well. But so that's kind of the intent behind this. If you guys have feedback, definitely let me know. Shoot me a message. You can put it in the chat box. If you have questions, we'll be doing a Q&A at the end of this as well. And that way, hopefully we can get all your questions answered. And then so this is a regular monthly webinar. And then it coincides with a report that I put out. So the report will be released in the next day or two. And that's basically the written version of this brief. So you get to have something that you can reference. It's a little bit more detailed and hopefully enjoy that as well. So I will also be welcome Amy, how you say that? I'll also be doing other webinars just on basic real estate topics. So in the past, I've done multifamily fundamentals. So if you're new to multifamily, definitely check out my YouTube channel. Since you're signed up on this, you'll get the replay of this webinar, and then that'll link you to my YouTube page and you'll be able to see my past webinars. So I've done multifamily fundamentals, how to use an IRA or a 401k to invest in real estate. And I think the next one's going to be how to choose a market. So definitely look forward to that, and hopefully you guys can attend to that as well. All right, let's get into it. So this is the State of the Union. All right, so a bit about myself. So I've been originally from the Boston area. Right now, like I said, spending a lot of time on the West Coast and South Dakota. Background is aviation in the military. So I flew the B-1 bomber. I was in the military active for 8 years. I got about 2,500 hours in that jet. And I started investing in property in 2011. So I bought my first duplex. I house hacked. And that's what kicked off my career in real estate, right? My addiction to real estate, if you will. I'm also a purveyor of the cryptocurrencies. So crypto right now is having a really good run. I think in the last 24 hours, we're up $600 or $800. On the week, it's like $1,500, $2,000. So it's sitting about 13,500 right now, which was the last price I saw this morning. If you recall, in 2018, basically went from like $1,000 to $20,000 in just a couple months, 2 or 3 months. So I'm pretty bullish. I think this could be the start of a long-term bull run for cryptocurrency. It's still not really being talked about in the news much. So I think once it starts to approach that previous all-time high, we could see things really kick off. And of course, we've got what the Fed's doing, printing all these dollars, inflation. So it's kind of a hedge against that. All right. And now, of course, with Mach 1 Equity, my brand, I look for multifamily properties and other real estate investments. So if people are looking for passive opportunities to invest in real estate, they can invest with someone like myself, usually a tune of $50,000 minimum, and just be completely hands-off, just no part in the day-to-day. That's something that we would take care of, and they just collect the benefits. So with that, exciting times right now, potential investment opportunity come up. We're still kind of in the negotiation for the final PSA, but it's looking really solid for a Class B acquisition in Houston. Some of the things I really like about it, Houston market's a really strong market right now. It's one of the top performing growth markets in the US. This is going to be a over 200 unit property. So you get really good scalability. You can have an on-site manager, maintenance tech. You can have some assistants there as well. So the scalability is really good from an economic standpoint. Probably be about a 3 to 7 year hold, depending on what we decide to do when it comes, once we've captured some of that value, we could refi or we could just cash out and sell the property. It's looking right now about 8% cash on cash for a total return of about 100%. So I'm pretty excited for that. So look for that offering on my list. If you're interested in something like this, definitely go to mach1equity.com/take-action. You can fill out a brief investor questionnaire and just put in the comments that you're interested in investing, and then we can connect and hopefully get you on the investor list. All right. So what's going on with the economy? It's actually looking a little bit sluggish right now. So the September jobs report, we had 661,000 jobs added, which sounds like a big number, but it's about half of what was added in August. So definitely a slowdown. It missed the expectation by about 140,000. So, and you can just see in this chart for monthly job growth, you can see the huge decline in April as we had the shutdown. You saw the initial bump after things opened up, and it's just been petering down ever since. And it's unlikely that we're going to see this big uptick anytime soon. We don't have any stimulus coming. So we're looking like it could be a sluggish recovery going forward. So far we've recovered about 11.5 million jobs, but we're still down about 10.5. So just over halfway in terms of job recovery, but still a long way to go. Last month, we had the biggest gain was in leisure and hospitality. So think like hotels and restaurants. So 318,000 jobs in that. But the restaurant sector is still struggling. It's still down like 2.3 million jobs overall. So you can still see there's a lot to make up there. Retail has also been gaining about 142,000 jobs, but that's still down 600,000. That's recovered a little bit better than leisure and hospitality. Government was a big loser last month. So government lost 216,000 jobs, which was mostly due to the census. So about, I think it was 35,000 census workers were laid off. And then there was a couple 100,000 education jobs. So state and local government education jobs were lost. So, a big problem with these schools being shut down is maybe the teacher retains their job because they can do like a Zoom classroom type thing, seems like what they're doing. But what about the janitor? What about some of these other in-house jobs that really have nothing to do right now when the school is actually shut down? So your lunch ladies, things like that. So with this jobs report, unemployment did tick down. So we're below 8%, which is a nice, I guess, psychological bump. So down to 7.9. The expectation was 8.2%, so it beat the expectation a little bit. But I always like to stress that the true rate of unemployment is always going to be higher than that top line number. So that's about 12.8% right now. And what goes into that is it doesn't include, your discouraged or underemployed workers. So how these unemployment numbers are calculated, it's important to kind of have an understanding of that because it ties into the total labor force participation, right? So what's going on right now is about 4.5 million people have left the labor force since February. So it drags that unemployment number down because there's a ton of people, like think about those 2.3 million restaurant workers. They're probably not even looking for jobs if they were to be surveyed. They say, yeah, I'm not looking for a job because my restaurant's still closed down. I'm a bartender. What are they going to be applying for, right? So the reason they're not looking for work is really because they're prevented from doing so because they don't have that opportunity because of the pandemic, right? So it drags that unemployment down and makes it look better than it really is. All right, unemployment claims. So these are still a problem as well. So they're kind of lagging. So we've got total about 23 million people on unemployment. So as I said, the labor force, how that's calculated is we got everyone with a job and then everyone collecting unemployment basically or searching for a job. And then everyone else is out of the labor force. Usually that's hanging out about 63, 64%. Now I think it's about 61%. So it's dipped. So we still have 23 million people on unemployment. That did drop by 1 million, which is good, but it's still a big number, right? And weekly claims are still coming in about 1.3 million. So there was some positive news with the initial claims. So people filing for traditional unemployment, if you will, dipped below 800,000. So they're saying, oh, finally, for 1 month out of this, we've gotten, or 1 week, gotten below 800,000. But prior to this pandemic, the record was like 600 something thousand back in like 1982. So it's still a huge number of people that are filing for unemployment every week. And then you get the 1.3 million because there's the pandemic unemployment assistance, which is like that federal benefit that came with the CARES Act for mainly like your gig workers and that sort of thing. And that's, people are still signing up for that to the tune of like $500,000 a week. So you can see that chart again. April, you see this huge spike and then it drops considerably, but now it's just kind of, it's almost flattening out from August through October. So that's not good. We want that to continue to tick down. Also, permanent job losses are rising. So they're saying about 345,000 jobs that were previously classified as temporary have been moved to permanent. So that's up to 3.8 million, which is a 2.5 million increase since February. So overall, like I said, things are just slowing down in the jobs market, which isn't good because this pandemic, we could see almost like a second hit, a second dip to the recession, because there's potentially a lot of people, especially your white collar workers that really weren't affected initially. They're starting to lose their jobs because now the business as a whole just isn't where it was previously. So it's not good. We need some stimulus for sure, I think, but that is definitely not going to happen this week. And I think it's unlikely in the lame duck period. One thing that is going on, which is really interesting, is consumer savings. So there's been this big surprise in consumer savings over the last 6 months, which is as the Great Shutdown happened, for pretty much everybody, it removed our opportunity to spend, right? So even people that wanted to go to bars, wanted to go to restaurants and spend money, they couldn't. They just had nowhere to really spend their money other than maybe online sales ticked up. But basically it produced an environment where it was like this involuntary savings boost, right? So you can see on the chart to the right there, you've got the CARES Act took place in April. So you see this dip in employee wages. So that's the blue in that chart. And then you can see the unemployment benefits is represented by the orange. So what happened with that CARES Act is people were receiving $600 a week in additional benefits. For a lot of people, it meant they were making more money on unemployment than they were previously. So you can see the delta there, especially May and June, where total wages were higher than they were prior to the pandemic. So it increased people's take-home pay. They also can't spend because everything's shut down, so it boosted savings, right? So the ultimate effect is that the unemployed people doubled their savings during that time period. So they actually outpaced the employed people spending by saving by about 80%. So some of that could probably be attributed to, hey, they don't have a job, so they're tightening up on their spending anyways. But you can see in that chart, so the blue line is people that were receiving unemployment, and you see this is their savings in comparison to where they were in January. So they took about, I think it was 80,000 accounts on JP Morgan Chase, and they knew they were receiving unemployment, so they could see how much they had in their account in January, how much they had at the end of July when the CARES Act expired, and it was more than double. So it really extended the life of the CARES Act, because you can see in August when the CARES Act expired, that savings got depleted by about 2/3. So now people are spending it on, their bills, right? Their consumption, things like that, rent. So we can expect that to deplete in September and October. It's probably already gone by now at the end of October. But what it did do was it kind of kept the life raft going through September and October. So now that that's gone and there's no additional stimulus coming, that's going to compound the situation, right? So we could see this almost delayed effect in terms of the hit to the economy and to, rent collections, whatever. We could see a rise in bankruptcy, delinquencies, all these things, because that savings is now depleted. So just a pretty interesting thing that came out of that. All right. We are a week from the election, so I wanted to talk about the Biden effect. So Biden is in all but of the 13 battleground states, he's up in all but one. So for all intents and purposes, he's going to win, barring some unlikely scenario, right? He's I think has like a 95% favorable chance to win over Trump. So I think it's important that we talk about what the effect of a Biden presidency will be, because he's got some initiatives that will affect us. So, and I just think that picture's hilarious. And the byline, insane dementia patient demands to see corn pop. If you haven't seen the corn pop speech from Joe Biden, look it up. It's something else. It's really funny. Anyways, all right. So let's talk about the Biden tax proposals. So big picture, he is looking to, have his tax proposals favor the lower income, if you will. Basically, anybody below $400,000 in income, he's saying is not going to be affected. Everybody above that, he's going to increase their taxes. So the federal income tax rate, he's going to increase from 37% to 39.6%. So not really a very heavy increase there. But he's also going to increase the corporate tax rate 21% to 28%. So a fairly substantial raise there. It's about a 30% increase in the corporate tax rate. But 28% is still pretty low. I believe under Reagan, when he took office, for most of his administration, the corporate tax rate was like 48, 49%. And Reagan lowered it to like 41, 42%, something like that. So it's still very low. And actually, corporate profits prior to the Trump tax cuts were actually higher than they are now. So taxes don't have as big of an effect as people think they do. But it's worth noting. Like I said, he's gonna increase the payroll tax on people making $400,000 or more. He's also going to increase the dependent tax credit from $3,000 to $8,000. So anybody with a dependent on their tax returns will get a credit of up to $18,000. If you have more than one child, I think it's $16,000, and I think it maxes out at $16,000. But again, that goes back to his policy of kind of helping out middle America, Main Street America, if you will. He's got some initiatives for tax relief for student debt forgiveness. I don't know all the specifics. I believe part of it is proposing relief if somebody does public service, they can have their student debt forgiven or part of it. So I thought that was kind of an interesting approach to it. And then he's also looking to drop the estate tax exemption by 15% or 50%, excuse me. So there's probably a lot of people that are looking to pass on a lot of wealth to their heirs that are not excited about that. And a lot of those people are probably donors to Joe Biden. So I think Joe Biden, he's pretty corporate. He's like vetting Republicans for his cabinet. So I think a lot of his policy proposals won't actually get pushed through. But, I'm sure there'll be some increases. Maybe the federal income tax and the corporate tax rate go up, but probably not these large moves like the estate tax drop. So now there's some real estate specific proposals as well that are especially interesting or important for us. So the big one is there's been a lot of talk about his comments surrounding the 1031 exchange and limiting who can utilize that. So if you're not familiar with the 1031 exchange, basically when you sell a piece of real estate, an asset, let's say you bought it for $100,000, you're going to sell it for $500,000. You have a capital gains on $400,000 of gains, but you can defer that tax if you put that money into another piece of real estate, right? So this is a huge wealth building strategy for a lot of Americans. It's not just used by the super wealthy. This is Main Street, people buying and selling small properties use this quite often. So he's looking to limit that to people that make $400,000 or less. Very few people really make $400,000 or more a year. I'm not quite sure how that's defined, if that includes your unearned income, because if you're making $500,000 off the sale, does that include you? I don't believe that's true, but they haven't quite clarified that yet. But the bottom line is this is so entrenched in the real estate industry that the likelihood that there's any changes to that is very minimal. You could argue there's an entire sub-industry of consultants, attorneys, intermediaries that revolve around 1031s. So there's a lot of lobbyist power backing this. The realtor lobbyist is one of the most powerful lobbyist associations in the country. So when push comes to shove, the political will to overhaul that system probably just isn't there, right? So I think that's important. I just don't see that happening. He's also looking to potentially repeal step up in basis. So what this is it increases the tax basis for inherited assets to their full market value. So imagine you're going to inherit property from your parents. So if that property is worth 500,000, but your parents bought it at 100,000, like that example I used previously, there's that $400,000 gain. When you inherit that property, the basis becomes whatever it's worth at that time. So your basis would be 500,000. So if you sell the property right then, you wouldn't have capital gains. If you held it and it went up to 600,000, you're only paying tax on that $100,000 difference. So again, I don't see this coming to fruition. That is a key component in a lot of tax and estate plans. So there's, a lot of people that their entire estate plan centers around, these types of policies. So I don't see the will for that happening as well. He's also considering restoring the first-time homebuyer credit. So that was something that came out of the 2008 recession. His proposal, I believe, is up to $15,000 for first-time homebuyers. I think that's really interesting because right now, the home market is already very frothy. Like, it's hot. So if you add in this extra incentive to buy homes and you're going to increase demand, it seems like who knows what's going to happen of that. That's kind of crazy. We've got all-time low interest rates. We'll talk about that. But I thought that was interesting. So that's probably a very easy thing to get through. But who knows if that is really necessary, I guess. But all right, so speaking about housing, so I opted not to put specific data points on this and just kind of look at this from a top-down approach, big picture, 10,000-foot view. A lot of the data is coming out this week for home sales, so next month's report will probably have more of the data specific, but the big picture is that seller's market is still just unrelenting, right? We've got record low mortgage rates that's driving a lot of that. So mortgage rates dipped again about 10 basis points to an even 3% is kind of the average. But, a lot of people are getting 2.75. I've heard 2.25. So it's like free money pretty much. So that I think is causing a lot of the demand. It's kind of a fear of missing out on that, the FOMO effect, if you will, from home buyers that are like, hey, I was going to buy a home in the next 2 years. I got to strike while the iron's hot. Home prices are going up. These interest rates are dropping. They're probably not going to go much lower than they are now. And that's driving demand. You've also got lack of supply that continues to be a big issue. So we're unlikely to see the supply change anytime soon, unless there's like a glut of foreclosures or something. But right now, people have equity in their homes, so they can sell and walk away with cash. It's not like 2008 where we had this housing crash. That's not the case right now. So even the people that have lost their jobs, they've got an exit strategy potentially, right? So we're probably not going to see a lot of foreclosures. Home building is pretty restricted right now, in large part because we've got a lot of material costs going up. So material costs have been going up because of the Trump trade war. So bringing in lumber from Mexico and Canada has been restricted. So we're seeing some dips in the imports of materials, which is driving up building costs and limiting new construction. So those factors, like I said, it's a really frothy market. And what happens after if he brings on that first-time home buyer credit, no telling where it'll go from there. So I think long-term, I think the housing market's going to be pretty stable. We might see it cool off a little bit in the future, but I don't think we're going to see like a crash or anything like that. I just don't think that there's really data that supports an argument other than, hey, it's been going up for 10 years. It has to stop eventually. So I think in a few years when interest rates start rising, then the buying power of buyers diminishes. So maybe you'll see prices decrease from that, but interest rates are expected to remain stable for the next, year, 2, 3 years. So All right, now looking at commercial multifamily. So overall, throughout this pandemic, multifamily has been very stable, just really across pretty much every metric. It's been stable: rent collection, rent growth or rent declines, um, purchase prices haven't really been too affected. There was definitely a dip in transaction volume during the shutdown. There wasn't a lot of properties trading, but we've seen a big uptick in transaction volume in Q3. So that's pretty much rebounded or close to it. It's going to continue on that trend. And like I said, there hasn't been that COVID discount. So you can see in that chart to the right, cap rates are holding steady, prices are holding steady. There hasn't been this big 5 or 10% dip that a lot of people expected to see. So I think that it's going to continue like that. Rent collections have been very stable. Like I pointed out, the savings could be boosting that, but so far it just hasn't materialized. Some things that buyers are facing is stricter lending requirements. So lower loan to values on their loans are being approved, and lenders are requiring higher reserves. So typically I'm hearing about 12 months of reserves required to have on hand. So that means you got to raise more money, and it does change the picture a little bit. It makes it harder for a deal to pencil out, but it doesn't seem like that's been reflected in pricing yet. If that continues, maybe it will, or maybe that reserve requirement will go away in 3 to 6 months, and it'll just be kind of a blip on the radar, right? But overall, I think the outlook is very optimistic. Like I said, those low rates are here to stay for the foreseeable future. And overall, there's still just solid fundamentals in terms of long-term demand, the demographic trends for rentals and apartments. Here's a look at October collections. So October collections, they actually beat out September just slightly up through the 20th. So collections are strong. As I said, that's propped up by the CARES Act and the savings boost. But I mean, I've been kind of predicting a decline in rent collections in September and October, and it didn't materialize. So I've been wrong. Maybe there's not going to be any effect in the next few months. Maybe it continues like this, or maybe we do see a decline as that savings dips. So kind of remains to be seen. All right. Some other kind of macro trends. Larger gateway markets are pulling down some of the averages in terms of rent growth and rent growth and vacancy. Mainly your secondary and tertiary markets are outperforming because they have some drivers that are attracting people. They've got lower population density. So I think COVID, people want to move to where it's not as crowded. They're getting out of these urban cores. It's more affordable in some of these tertiary markets. And there's also kind of a trend of attacking tech talent to some of these emerging hubs and markets. So that has been a trend for a few years, but COVID basically just sped up that trend. Also, the suburbs are outperforming their respective urban cores. So you can see in that chart to the right there, apartment vacancy, downtown versus suburbs. Downtown's about 1% higher than the suburbs. So it's not, is that very material? I mean, 1% out of a 100 unit apartment complex, that's, one unit. So it's not huge, but it is a noticeable trend, which is interesting. Absorption rebounded in Q3. So that's also a good sign because we saw absorption dip in Q2 during the shutdown. Nobody was moving. Nobody was picking up these new apartments as they came online. That's largely recovered, and that's going to help keep rents stable as well because that indicates that there's demand, and it keeps those builders from offering high concessions or dropping their rents. And that's reflected in the chart to the right. So as I said, those smaller markets are performing better. So you can see that top line, the Midwest, they actually have seen rent growth continue through this. Whereas you can see, the Northeast, for instance, that's a much more densely populated area. They've had rent decline by about 2%. So I think, and then you can see down below gateway versus secondary and tertiary, and you can see the difference there as well. I thought this was a cool chart. This basically compares that trend of rent growth versus average rent. So like I said, the more affordable markets are performing better. So you can kind of see this breaks it down by the actual city. And if you just look at the cities that are performing the worst, you've got New York, San Francisco, Boston, LA. Those are seeing rent declines, and they're the most expensive compared to your cheaper cities, Columbus, Sacramento, Inland Empire, Phoenix. They're continuing to see rent growth, and they're much cheaper markets. So pretty cool. And here it is on more of a regional scale. So again, the Midwest tertiary doing really well, the Gateway Northeast underperforming overall. So all right, so that is this month's State of the Union. As I said, there's going to be a report released this week, the Mach 1 report. Volume 11 comes out this week. So you can look for that. That comes in conjunction with this update. So if you want to actually read it and have something to reference, share it with your friends. You can go to mach1equity.com/economic reports and look at previous iterations. And then, as I said, if you missed it at the beginning, potential upcoming investment opportunity in Houston, Texas. So my partners and I are hammering out the final details of a PSA for a apartment complex garden style in Houston, Texas, Class B, greater than 200 units. So you got great economies of scale. Looking at probably a 3 to 7 year hold, 8% cash on cash for a total return of about 100%. So if you're interested in that, definitely reach out to me. You can go to mach1equity.com/take-action, fill out the brief investor questionnaire there, or you can reach out to me direct. My number is shown there along with my Calendly as well if you choose to go that route. So that is this month's formal portion. Let's go into a Q&A if you guys got that. What questions do you guys have that I can answer? Throw it up in the chat box and answer whatever questions you have. I will send the recording out. Usually it takes me a day or two to get that out because the file takes a few hours to render from Zoom, and then I got to make some trims and edits and upload it to YouTube. So probably in the next day or two, I'll send out the recording. But if you go to my website, you can go to the past webinars and find my YouTube channel, and that'll show you some of the previous webinars as well that I've put up. So, hey, you're welcome, Daniel. I appreciate you coming. Appreciate you taking the time. And let me know, guys, too, if you guys have preferred time that this sort of thing works for you. I've been trying different times. I've done Saturday mornings. I've done early evening. Thursday mornings around this time seem to be pretty good, but you know, everyone's different. I'm trying to find a good balance of when to do it. Any questions, guys? Sunday evening? Okay, I'll think about that. I was kind of hesitant to do Sunday evening because I thought that there'd be a lot of people that maybe were doing kind of their last family time before the week, or you know, just kind of trying to relax before the work week. But hey, you're welcome, Joel. Appreciate it. Appreciate you coming. Everyone is home now. Yeah, this is true. Joel doesn't like Sunday. All right. Take care, guys. I think it doesn't look like we have many questions, but appreciate it. If you're watching on YouTube, like it, comment, share it, tell your friends, tell your family, tell mom and dad, and help me out, subscribe, and let me know if you have any feedback. So Appreciate it. What's my thoughts for the market in 2021? So, are you talking single family, multifamily, the economy as at large? Single family. Um, I think it's going to continue to be strong. Like I said, I don't see a glut of supply coming on. So in terms of purchase prices, I don't see like a decline coming. I think there could be more supplies. People have to sell their homes if they don't, if they lose their jobs and things like that. But generally, the class that's been most affected by this is the renter class, anyways. So if you're a property owner and you're renting, it'll probably help you actually, because there's probably going to be increased demand for rental units. That's typical of an economic recession, right? I don't think that rates are going to go up. They may go up slightly. I think that we're starting to get to a point where banks are saying, hey, the delta for them just isn't worthwhile. They're not making enough off of a 2.25% loan. I think eventually they're going to set a floor. I'm actually really surprised that banks haven't set a floor around 3% already, but I think they're just, I guess they're just being competitive. So I think it's going to be largely stable for the most part. Multifamily, kind of the same thing. I think there could be some properties that are, I don't want to say they're going to be like this massive level of distress of, 40-50% vacancy, but because the renter class is the most affected and there are restrictions on evictions and things, we could see some weakness in the multifamily market from a operations standpoint. Whether or not that translates to a discount remains to be seen, because it is also a pretty frothy market. So we saw leading up to this, there's a lot of people in a lot of markets that were willing to overpay for property because they're just thinking, hey, in 10 years, this is going to be worth, I'm going to do okay long term, right? So it seems like some of the institutional buyers have backed off. So people no longer competing against them. That could be helpful for, commercial multifamily acquisitions, but the private office, the private equity offices have it would seem they've filled that void. So I think there's still a lot of money that is moving into multifamily, especially the fact that it's held up this well 9 months into the pandemic is just adding to the popularity, I think. And if you're one of these fund managers that is managing large amounts of money, T-bills are, worth nothing right now. There's nowhere to put their money. So I think that they're going to continue to look at multifamily. Any thoughts on the effects of people taking forbearance on mortgages? So that's an interesting one, because if they're taking forbearance, I believe when the CARES Act dropped and they dropped that provision, it gave them 12 months of forbearance with potential to extend beyond that. So the thing about that is that's a long time for someone to get their act together and find a new job and avoid selling their home. So that could contribute to the lack of supply that we were talking about, that instead of this, wave of homes coming on the market, they're going to be maybe limited. The other thing that's the big picture of all these markets is banks learned from 2008, 2009, 2010. They had this wave of foreclosures. They don't want to go through that again because they realized they were selling these assets for 50, 60 cents on the dollar, maybe less. They weren't really coming out ahead. They don't want to foreclose on these properties. So they're much more likely to do a workout with the current owner than foreclose on the property, or at least try in some regard, right? So the likelihood that that's going to happen is increased, that they're going to maybe try some sort of workout. Some people think there will be an REO wave in Q1 2021 due to mass foreclosures. Have those foreclosures begun? Foreclosing doesn't happen overnight. It takes a while, right? So no doubt there will be an increase, right? Is it going to be like 2008? I don't think so, because a lot of people have equity in their home. We're coming up on 11 year 12-year bull run. So unlike 2008, where people were underwater and hey, they lost their job, they're underwater on their mortgage. What are they gonna do? Sell the home and be in debt 60 grand? They're just like, hey, I'll just ride this and just they can foreclose it. They can have the house. They don't care. Get me out of this. So now it's different. People have equity in their home. The lending requirements coming out of that were a lot tighter. So they weren't making these kind of predatory loans toward a lot of people. So it limits the effect of that as well. So there's a lot that goes into that. I just don't see it being very material. Like I said, there will be an increase, but I don't think it's going to move the market considerably. I could be wrong. Now, what is a variable right now that generally in terms of the larger economy and how it plays in all this, the big question is what's going to happen with this economic recovery. Like I said, it's already slowing down and we don't have any stimulus coming. Stimulus is what has driven the recovery thus far. So if we don't get that stimulus until maybe February at best, then hey, we could see a dip, could see kind of this W-shaped recovery where we recovered a lip and now could have another wave of layoffs and a dip in the recovery. Also, coronavirus is picking up, so it's worse now than it ever was. So pretty crazy. And now we go into the winter. That tends to lead to a spike in virus infections. So could get a lot worse. All right. Any other questions, guys? All right. Rock on, guys. Happy investing. See you next time. Cheers.